Welcome to another episode of Learn to Read and Trade Any Market. Your host Panagiotis Diamantopoulos, and we are ready to go with lesson number 6, money management. But before we start, let's read the risk warning. Trade the Volume Waves offers general trading advice that does not take into consideration factors such as your trading experience, personal objectives and goals, financial means, or risk tolerance. Keep in mind that past performance is no indication of future results. So, learn to read the trade any market. This is a video series that we have mentioned several times in previous videos in TradingView and YouTube. And what are these video series? Short video lessons trying to explain the whole process of reading a chart using price location structure volume with a single tool, which weight with speed index. We have already covered that, so you need to refer to previous videos. And now we are going to money management. And later on, in one of the following videos, we're going to go to trader psychology. So, the target of this video series is to help out retailers to understand the following questions. Why did this move happen? What should my risk be? Where should I place my stop and target? What should I do to be successful? So, let's start with money management lesson. Your shop trading is like running an one-man shop, and like all shops and businesses, they have to be managed. So, your physical shop, if you had a physical shop or an e-shop, you would have to do the following. You would have to invest an initial capital to set up your shop. You will have to manage your customers and suppliers. Then you will have to sell your products or services. You have to pay the suppliers for expenses, and at the end, make profit. Okay, that's the goal. The goal is to make profit. So subtracting my sales minus my total expenses, I should be making profit. So let's see how this relates to trading. Okay. So this is your trading shop, huh? You are a one-man show here. So of course you will need an initial capital to trade. So this is the same. Now, the second thing is manage yourself, not the customers or suppliers, yourself. You need to manage yourself. That's the difficult part. This has to do with trader psychology, which will be one of the lessons we will host in the future. Now, your wins are selling a product or services, it's equal to your wins. You are making some money when you win. But then you also have losses, you also have broker commissions, okay? And these are your expenses. You should consider always a loss or a broker commission as a business expense and not as a mistake, okay? And then subtracting these two, wins minus losses, you should make a profit. So this is a one-man show for you guys. Let's go then. So in order to run this shop, one of the most important lessons is money management lesson. Okay? If it's not the most important, which I believe it is, at least it's second in the rank. What's money management? The definition is to manage your trading capital and optimize your trading performance. How to do that? Managing, it means putting some rules down and sticking to them, okay? And these rules must be smart and based on mathematics, probabilities, and statistics. Now, all the calculations you're going to see in this presentation will not include broker commissions or swap for simplicity. So what mathematics? Well, percent of risk. How much we're going to be risking on every trade? Maximum drawdown. Let's define this as how much can I lose within the day before I stop trading? Okay, and then because there will be bad days. Risk reward ratio. Okay, so I want to risk one. What should I be gaining? What should I be targeting as gains? 1 to 2, 1 to 5, 1 to 10. Probabilities. Okay, now there is a nice, excellent article about risk and money management in trading from Option Matters to understand the mathematics and the probabilities. So, right here at the bottom, you can see the Option Matters URL, so you can visit and read the article. Very interesting. And now, let's get some stuff from this article and try to focus on that. So the Option Matters Montreal Exchange says the golden rule, you should not risk more than 2%. That means on every trade, you should not risk more than 2% of your equity. For example, in a 5,000 euro equity, every trade should not be more than 2%, which is 100 euro. In a 10,000, that's 200 euro. Okay, that's the golden rule everybody uses is the 2%. Okay, this can be increased if you are having a good system. Okay, can be increased to 3 or 4%. Now, the next thing that these guys are saying is if you lose, okay, and this has to do with the drawdown, okay, in order to regain the capital you lost, they mean to break even, okay, you need to follow this rule. That means if I lose 20% of my capital, then I need to grow 25% in order to break even, all right? So, the less we keep this number, the less effort we need to regain, to break even. Now, look how this goes. If you are at minus 10%, you only need 11% to break even. Here from 20, we go to 25. From 30, we go to 43. From 40 to 67. So, if I miss half of my capital, in order to regain it, I need 100% up. Okay, so this is very important rule and it has to go with a drawdown. One more thing to note, that's a probability system. Depending on your winning rate, you have a probability of consecutive losses, okay? Whether you like it or not, you are going to lose. And you are going to lose many times consecutively. So they're saying that a win rate of 30%, okay, it has a probability of 2 consecutive losses, 49%, and of 4 consecutive losses, 24%. Okay? A better system, which has a 60% success rate on the trades, then it has a probability of 16% of getting 2 consecutive losses and 2.5% of getting 4 consecutive losses. So let's check out these numbers, how they are calculated, because they are very, very important. All right. Now, as a rule of thumb, these guys are saying that you need to plan to have at least 5 to 6 consecutive losses at some point. Now, the rule of thumb they use on the drawdown basis is if you multiply the number of consecutive losses times the percent of risk that you have set up in your trading methodology, you should not exceed 25% of your portfolio. This is a very nice, good rule. Now, let's look at an example of what we mean by 2%. Okay, and if we get 5 consecutive losses. So the capital is 10,000 euros, dollars, whatever. The risk is 2%, and we get 5 consecutive losses. So since it's 2% of 10,000 is 200 times 5 losses, we will lose $1,000. Okay, so our new capital will be 10,000 minus 1,000. That's 9,000 capital after our losses. So our equity growth it's minus 10%. Correct? Wrong. So why is it wrong? Because if we follow the rule that we use the risk of 2% on our first trade, we will risk 200 euros here. Okay, here is dollars. Sorry for the mistake, but you get the point. So our capital will be 9,800 after our first loss. But on the second trade, since we're going to use again the 2% rule, now the 2% on 9,800 is not 200 anymore, it's 196. So basically, after 5 losing trades, if our trades are not one on top of the other and we wait for one to finish and then go to the next one, will be 9,039 our equity and not 9,000. Okay, so our losses will be 9 minus 9.6 and not minus 10. Okay, that's again, as I previously mentioned, without broker commissions or swap. All right, now. Before we go to my money management ingredients, let's go to these Excels, some Excels to show you what is happening with actual scenarios that these guys have told us. All right. So let me go to my Excel. All right. So this thing that they said that in the 30% loss, we need 43% to regain and go back to break even. So basically 30% loss. Here we got an Excel scenario, okay? The date is not important here. Let me hide it. Okay, 10,000 euro start, 2% of risk, okay? And this is our losses. Let's say that we are continuously losing. So our capital, we will lose 30% of our capital within 19, 20 trades. So that's the equity loss. So right now we have reached 70%, exactly what these guys are saying. So minus 30, and our equity became to 6,951. Now, in order to regain this from now on, let's assume with risk reward 2 and 2% equity risk, how am I going to grow? So from now on, we are winning continuously, okay, until we reach the 10,000, which is our break even, our capital. So this is where we reach the 10,000, all right? So basically, from 6,900 to reach the 10,000, each 43.9%. And this is exactly what these guys are saying here, all right? And this is our equity going down to 70 and then going back to 100. So it took me 19 consecutive losses and 20 consecutive losses to lose and regain my capital. Now the same story goes if we try to understand this 90% all the way down here. It says if you lose 90% of your capital, then you need to regain it 900% increase. All right, now let's do that. I have it right here. So the assumptions are again 10,000, 2% risk on every trade, okay? And you know that this is the risk on every trade, okay? And we continuously losing, so it's not 200 euros, it's decreasing. So this is our pip cost, okay? If it was, you had the pips here, I got 25% pips loss, for example. So this is cost per pip, and we start losing until the 10,000 becomes, let me put a freeze here. Okay, and freeze, all right. It's moving anyhow. So we're going down to zero, and here we have not to zero to 1,000 euros, and this is 10% of our total equity, which means 90% losses. So in order to regain our capital, and from now on, I'm restarting to go down to win, okay, all the way down. The result is up here, and it says in this curve from 10,000 to 1,000, and then from 1,000 up, okay, and these are the calculations. So I needed 117 trades to go up to my original capital. So these guys are correct. Okay, this is all theory. But let me show you now what is my ingredients on trading. Okay, and some actual numbers, not theory. So this is my management ingredients. Of course, there are a lot, but I will show you something which I use and it has been successful for me. So I need to set stop and target according to structure, not according to uh, fixed pips or something else. Okay, why according to structure? Because you have been trained, everybody has been trained to trade at specific locations, and these locations are structure based. They are support, resistance levels, Fibonacci, pivots, stuff like that. So, this is where I set my stop and targets. I use 2% risk, okay? Whatever my stop, it's 20 pips, 100 pips, 200 pips. I will never risk more than 2% on a single trade. And then I use a maximum drawdown of 16%, which means for the 2% risk, 60%, that means I will stop trading on a specific day if I reach this maximum drawdown, okay? And as we noted previously, in order to gain 10% drawdown, you had to only increase your capital by 11%, okay? For 20% drawdown, you had to increase your capital by 25%. So what's next? The risk reward ratio is 1 to 2 plus if possible, okay? At least 1 to 2. 1 risk, 2 reward. That means if I risk 200 euros, then my reward should be 400. Now, the next thing I do is never trade a trade if a structure does not allow this risk reward. That means if I'm breaking through a Fibonacci area and my next significant support level is at 1-to-1 ratio, I will probably not risk anything and I will not trade unless I got my background, other stuff really enforcing me to do that. Or even if I do, the one to one. When my profit level reaches the one to one, I will move my stop